Welcome to the Art of Money podcast with Art McPherson.
Thanks for listening to the Art of Money podcast, artofmoneyradio.com for more information or to schedule that initial consultation. Appreciate you subscribing. Now, let's get to the show. We were talking about the U.S. debt getting downgraded late last week and a half ago. I need you to explain that to me. Give me the Cliff Notes version, the Idiot's Guide version. What does this mean? But more importantly, what does it mean for my bottom line and my finances?
Yeah, so the Cliff Notes version, right? Fitch is a bond rating firm, and they downgraded the U.S. Treasury debt from AAA to AA plus. So still a lot of A's in there, but it's not the best rated anymore. You know, the last time our debt was downgraded was 2011. You know, Moody's and Standard & Poor's jumped in on that one, so it was even a bigger event. But what Fitch said, what the company said, is because of massive deficits, fiscal deterioration, and erosion of governance. So when you look at our debt and how fast it's climbing, I mean, it is astronomical. Anytime we have a bad event, we print money, but then into the future, we think we can still print that money and still use that in the budget. That's been our issue since 2008 and 9. This year, we're on pace to be about $1.8 trillion in debt.
And that's just on the fiscal budget.
That's on the fiscal budget. And that's for this year where there hasn't been a recession. There hasn't been a pandemic. There's been a couple bank bailouts, but there hasn't been like a massive need to print money. It's just happening, right? And all the while, right, tax revenue's down. So for the first 9 months through June, tax revenue's down 11%, while spending is up 10.5%. The deficit through June is already $1.4 trillion, already ahead of the full year of 2022. We are on a crash course. Right, the train is going off the rails, and we'll see what happens. But this is not a good event for the U.S. Treasury, for our government, for the economy.
I'm looking at the U.S. national debt clock right now, $32 trillion. You know about that? How much that amounts to per taxpayer? $253,000 is what we owe down.
Just cut them a check. They'll be good with your money again.
Right.
So what can we
and
do?
The sad thing is, Mark, is they have in the budget right now, because it's supposed to be a balanced budget amendment. You know, the Congress passed that and the House passed that back in 2000. Well, back when we had Bill Clinton. That was when we had the Budget Reconciliation Act. So they have not balanced the budget since really Obama was president, and they keep doing emergency continuations of spending. But because they do these emergency orders, nobody has balanced the budget. So that's why we're running annual deficits like Luke just talked about. And all they would have to do is freeze spending, not increase it. Right now, for some reason, we think the government should grow at 8% per year, whether the economy is growing or not. So when the economy grew last year at 0.5%, the government grew at 8%. When the economy's grown about 1% this year, the government's grown again 8%. So in 2 years, the government spending went up 16% when the economy grew 1.5%. That doesn't make sense. We shouldn't do that. So it'd be a very, very easy problem to fix, but nobody has had the political will to even address it.
Okay, well, it's obvious that Congress, that the government, the administration is not going to do anything about it. What are you doing for your clients to help us out? When people call you up and say, look, I'm starting to get a little nervous about having to pay this down. They're spending freely. There's no control of it. How is this going to affect my retirement savings?
Well, one of the things we're trying to take advantage of right now is the current tax law. We feel like is probably going to be the best opportunity to take advantage of Roth conversions and take advantage of the low rates today. So we're getting all of our clients in here as soon as we can and as fast as we can. We've got 3 years left at our current tax code. So we want to do any type of conversion while taxes are discounted, because across the board, if you're middle class, it doesn't matter. And we go back to the old code, which is basically going to happen no matter what. So we don't need anything approved. It just automatically converts back to the old code. And if that happens, Mark says that'll probably be the best case scenario because of how much money they're spending right now. But if that happens, it's about a 25 to 30% increase in taxes across the board for most of our clients. So we want to try to do some conversions now to help save them in the future when taxes go up.
With the help of the in-house CPA at the McPherson Financial Group, his name is Mark Bernard. They're going to help you customize a tax strategy. And this weekend, if you've saved at least $500,000 for your retirement, give the team a call. That initial consultation, it is no cost, no obligation. 321 321-425-8550. You're going to sit down with Art McPherson and Luke McCarty, and they're going to personally customize a plan or take a look at your plan. Again, 321-425-8550. No cost, no obligation. And the latest numbers show that people are retiring earlier than expected. Morningstar's Christine Benz says a lot of them are making a decision without talking to a financial advisor. Here's Christine Benz.
First step would be to line up some help. I think a lot of people in this position might say, wait, I don't want to spend any money. But this can really be money well spent to buy yourself a plan, which is not to say that you can't do some work on your own to figure out what your plan is. But I think buying financial advice at this life stage can be money well spent.
So do you have any early retirees coming to see you at the McPherson Financial Group, and they regret the fact that they didn't come see you a little bit earlier?
We do. A lot of times we'll have people that have to live through the volatile times, and they don't realize how different a portfolio needs to be when you're doing income planning. Typically, everybody is used to how they invested for 30 years. You know, they put it in, they were contributing every month and, you know, kind of let it ride and didn't really pay too much attention to it. Had advice from the next friend, you know, in the next door cubicle, or Uncle Larry or Jim or Bob or whoever was helping you. But then all of a sudden it's time to retire. You've got $1, $2, $3 or more $1 million sitting there. It's more money than you've ever had in your entire life. And now you have to make sure that lasts throughout your retirement and provides that income stream you need every single month. And then how do you do that? How do you invest that? How do you distribute those funds accordingly? How do you do it with wisdom and do it in a way that you're never, ever going to run out in a good market cycle or a bad market cycle or an average market cycle? So that's where I think where a lot of people get very stressed and get very overwhelmed.
Yeah, and I'd add to it, you know, some of the regrets of not meeting us sooner tends to be about the taxation of their portfolio. Mark and I met with some potential clients last week and actually a couple weeks ago as well. And, you know, the consensus was, yes, you should do Roth conversions. You only have this year and the next 2 years. So you can convert 3 times over 3 taxable years. And then they looked at us and said, gosh, I wish I would have came here 4 years ago. We could have converted the whole portfolio. I could have been tax-free in retirement. You know, we can still get you to where certain years can be tax-free, or your legacy plan, right, can be tax-free. You know, if your RMD, your required minimum distribution is to age 75, you still have time to do Roth conversions after this year and 2024 and 2025. We just think, as Art mentioned earlier, taxes are going up, right? They're going back to the old code, the Bush-Obama tax code. You get one standard deduction. Your taxable income is lower in each bracket, and each bracket is higher. So your taxes are going up. So you do have this window of time. And after this window, right, we just change our game plan. There'll be something else that we can help you with. There'll be other tax planning strategies. But just know, just to harp on this a little bit more that Art brought up, right, you have a window now of 2.5 years. It could be the best taxable legislation in your lifetime, right? And, you know, taxes go up, they go down, but they usually don't go down this low.
I want to pivot a little bit and talk about some of the mistakes that we make in our retirement planning. The 401k is one of the biggest assets people have in retirement. Now, adults are making the same mistakes with their 401ks over and over again. So, Art McPherson, Luke McCarty, let's talk about that. What are some of the mistakes that you see, and how can you help prevent them within our 401k plans?
I'd say the biggest mistake is not recognizing your risk. Some of those funds, the target date funds, right, the 2025 or 2030 or whatever the date is, right, the longer out that date is, the more aggressive you are. So the shortened the date, like if it's to 2025, meaning, you know, you're close to retirement. But the problem with the 401k is the only way they can reduce risk is by reducing your equities, reducing your stocks, and buying bonds, right? Well, what have bonds done since 2020, 2021? Right, you're still down 13, 14%. So you can still have a lot of risk in the bond market. And I've said this before, right? Bonds and stocks have moved in the same direction ever since COVID, right? 2020, right? They were both down, right? 2021, they were both up. Last year, everything was down. This year, they're both up. So you're not getting that much risk parity between the two. So I'd be careful of just picking those target date funds. And the hard part is your 401k doesn't allow you to do much else, but that's why we're here to help. We have ways to get into your 401k. We have opportunities for you to roll money out of the 401k and just have something different in your portfolio.
Yeah, I think probably one of the things that is the most restrictive about a 401k is you can only choose the funds that are in your plan. So if you're in a larger firm, like we've got a lot of companies here in Brevard County, like your Harris's, your Lockheed Grumman, those type of companies that have lots of employees in Brevard, you're usually able at 59.5 to be able to roll part of your 401k or all of your 401k. And usually prior to that time, you can do part. So you can reposition money, get ready for retirement, start reallocating, and go into some of those investments that are not available in that 401k structure and be able to diversify even more. So you can continue to contribute. You can continue to be aggressive with your in-plan funds, but then you can also get out there and diversify. So it allows people to be able to take advantage of that.
Yeah, one of the biggest mistakes you can make with your 401k is simply not getting help and understanding how it can benefit your bottom line. Give the team at the McPherson Financial Group a call. Let's take advantage of that 401k x-ray. It's no cost, no obligation to take a look at your plan to see what adjustments need to be made. And if you've saved that $500,000 or more, all it's going to cost you is the time it takes to make the phone call. 321-425-8550. Always online, artofmoneyradio.com. And Art McPherson, Luke McCarty, ever since a 2020 change in federal law, interest in making annuities available in an employer retirement plan has grown. There was a study that found adults felt adding a guaranteed income component would ease their concern of running out of money in retirement. But Art McPherson, if an employer's 401k hasn't yet included this option, how can you help?
The only thing Luke and I have seen is they're going to take all the money and put it in an annuity provision. It's like, come on, make an annuity provision available where they can say, I want 25% of my money, or I want 35% of my money. So basically, Mark, the way Luke and I try to phrase this with our clients when they're going into retirement, when they've got their Social Security, they know that that's a certain number, and that's going to be coming in each month. How much more? So if Owens, you need $10,000 a month for retirement income, how much of that would you like to be guaranteed?
$10,000 a month.
Okay, there you go.
20,000, he said.
So it's doing those kind of conversations, right? So, when you're in the market and you have your money strictly in investments, we can show you the historical performance and we can show you the historical returns, but it's not guaranteed, right? So how much of that 10,000, like if you had half of that money not guaranteed, but the other half guaranteed, that's where annuities can play a role. And that's where guaranteed income can play a role. Because that way, if all else fails, you've got that portion of that retirement income coming in the door, 100% guaranteed, without any risk, without any volatility, no matter who's president, no matter what administration is in, and no matter what kind of policy for tax policy or economic policy, good markets, bad markets, it doesn't matter. You're going to be okay.
Yeah, and I'd say too, within the 401ks or even the TSP or 403b, whatever your retirement plan is, if there's an annuity offered, like Art was saying, right, you give all the money to the insurance company and you get a payment. Well, if you die within the first year, 5, 10 years, whatever that is, the money's gone. So what you're buying is a single premium immediate annuity. Art and I do not like these. We can get you the same type of payout and you still have the lump sum to pass to your spouse, to pass to your kids, to give to charity. You don't just give it all to the insurance company. I mean, you're basically saying, hey, here's $1 million, give me my money back for a while. Well, that's a big win for the insurance company. This is where annuities can get a bad rap because they potentially just giving you your money back unless you live long enough to get more. So we don't like those. And I disagree. I mean, halfway agree by giving it, the option of something different. But before you do anything like that and give all your money to an insurance company with no guarantee at death, give us a call and we'll give you some options and give you the pros and cons of all of your investments.
Thanks for listening. Want more from Art McPherson of McPherson Financial Group? Find us online at artofmoneyradio.com.
We are an independent financial services firm helping individuals create retirement strategies using a variety of financial and insurance products to custom suit their needs and objectives. Securities offered through World Equity Group, Inc., member FINRA and SIPC, a registered investment advisor. Investment advisory services offered through ProStatus Group, LLC. McPherson Financial Group and ProStatus Group, LLC are separate entities and are not owned or controlled by World Equity Group, Inc. Exposure to ideas and financial vehicles discussed should not be considered investment advice or recommendation to buy or sell any financial vehicle. Past performance is not not a guarantee of future results. Investments can fluctuate and when redeemed may be worth more or less than when originally invested. Investment financial professionals are not licensed in all 50 states. Art McPherson is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Please consult with your attorney, accountant, and or tax advisor for advice concerning your particular circumstances. Annuity guarantees rely solely on the financial strength and claims paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Arthur McPherson, Florida Insurance License number A174725.
Today's show has been a work of art.